From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for January 17th, 2025. Checking the calendar, your Milwaukee Bucks are home with Toronto tonight and Sunday with Philadelphia. And the Packers? Well, you know the story. Let's look a little ahead. On the 1st of February, in just a couple of weeks, it's Mitten Fest at Bernhardt's in Bayview. And 2 weeks later, on the 15th, it's the Cedarburg Winter Festival. So there you have a couple of things to get out of the house for. We have a cluster of stupid, weird stories today. If driving the Oscar Mayer Wienermobile has been an unfulfilled dream of yours, would you settle for the Nutmobile? Planters, the nut people, are looking for a driver for their Nutmobile. It pays $45,000 a year, and you get full benefits. You have until February 14th, Valentine's Day, to apply. You two can crisscross America in a goofy 26-foot-long peanut. The line forms right behind me. Sometimes you can find news in the strangest of places. In Oregon, a man's face caught on fire during surgery. He survived, but the family is suing for $1 million. You think? South Korea's impeached president gets a pay raise even while he's under arrest. What do you have to do to get fired over there? And finally, speaking of getting fired, a Polish general is fired after 3 missing anti-tank mines were found in the IKEA store. Now, what department would that be in? And to close out the broadcast today, we'll share a memory or two of Mr. Baseball, Bob Uecker. On the podcast today, we have Dave Sandstrom, Steve Giles, and with a look at the week, here's Joel Dresang.
Thanks a lot, Max. Yeah, it was a pretty good week, as it turned out. The NASDAQ rose 469 points this week. That's 2.4% to close Friday at 19630. The Dow Jones Industrial Average rose 1,549 points, or 3.7%, to close at 43,488. And the S&P 500 rose 170 points, including 59 points on Friday, to end up at 5997, which was 2.9% higher than it started the week. Since the start of the year, and this was the first week, actually, that we had gains in the market. But since the start of the year, the NASDAQ is up 2.4%, including dividends. The S&P 500, 3.4%, including dividends. And the Dow Jones Industrial Average is up 3.9%. Also, the U.S. Treasury is at 4.61% as of Friday, and that was down 17/100ths of a point from where it began the week. Dave, before we started recording, you said, if I may quote you, a fair amount of good news out there.
That's for sure, Joel. I mean, it's hard to get real upset or depressed about anything, what we're seeing out there from economic standpoint. We certainly saw midweek a reassuring inflation number, not necessarily blockbuster decline, but reassuring the markets, which resulted in an enormous up day across the board on Wednesday. And I think we've seen, if you're going to point to anything that has been really the focus of investors, I would say over the last 6 weeks, definitely the inflation picture. We have a change in administration coming up where some of the proposed policies bring up a concern about rising inflation as it relates to tariffs and some immigration practices. So I think that's really heightened people's awareness. So I think it was good to see that that December report came out and kind of justified the fact that it's not a runaway situation.
Right, and that was the Consumer Price Index, which is the broadest measure that the government has of inflation. It showed inflation up 2.9% from a year ago. That was the third month in a row that it ticked up. It got down to 2.4% in September. But remember, it was 9.1% back in mid-2022. And that's when the Federal Reserve was raising interest rates to try to bring that inflation rate down, and they they did that, and it's down where it is now, but it's still higher than what the Fed's target is, and that's 2%. So is that still a concern?
Yeah, I think as long as it's at odds with the Fed, it's a concern, right? Because if they have a target out there, the market is maybe at odds with the Fed. But I think what was a little reassuring from this report, if you looked at it closely, peeled back the layers a little bit, really the outlier is housing, is what we're down to now, is cost of shelter, which obviously is an important piece of that pie. But everything else within, if you look at exclude shelter from the calculation, we're back to pre-pandemic levels on the inflation number. Right. So I think that's encouraging.
Yeah, now it's just a matter of getting that shelter cost down. Steve, earnings season is underway. We've got, I think, 9% of the S&P 500 companies have reported earnings, and the forecasts are actually, they seem pretty healthy. And can you talk about that a little bit?
Yeah, as we start the earnings season here for 2025, I think a lot of investors are looking more for guidance from companies, Joel, than they are from really what the actual numbers are. I mean, the actual numbers certainly have been, I think, better than some people have been expecting, but the guidance is such that this economy continues to be on solid footing. Companies continue to expect a somewhat rosy outlook for the year. I'm looking at this year as more of a glasses half full perspective, and from what we've seen so far, based upon the economic indicators that came out this week regarding inflation and whatnot, that it's a solid footing to start the year on, and as we turn the corner into next month, we are certainly heading in the right direction, and this up week was a nice reprieve after a couple of bad weeks to start the year. Right
now, FactSet pointed out that the 493 companies in the S&P 500, that they're actually expected to be reporting their best quarter in more than about 2.5 years, and that's I guess reassuring, because we've been just sort of looking at that Magnificent Seven and how well they've been doing, but so the gains seem to be broadening more and extending to other companies.
Well, and as we all know, 70% of this economy is driven by consumer spending. So a lot of what we're seeing in profits and the earnings from these companies is coming from consumers' pocketbooks. And if the consumer stays engaged, if the consumer continues to spend, if the consumer doesn't tighten their purse strings, I can make the case that you could continue to see the kind of earnings numbers that we're seeing now continue into the second quarter.
What about concerns about the Federal Reserve, and it's kind of put a pause on lowering interest rates, which has affected some people?
Well, I think that's why we saw the market gyrate as much as it has over the last week. Last week we had data coming out suggesting that this economy was a little bit hotter than what everybody was expecting, and the market sold off big time. The indicator there was that if this economy is hot, there's no justification for the Fed to continue to lower rates at the pace they were in the second half of last year. But then we get the inflation numbers that come out this week suggesting that, okay, maybe inflation is percolating a little. We're off of those lows that we had earlier in the fall. And because of that, it might give ammunition to the Fed as reasons why they should continue to lower interest rates maybe at a more meaningful clip than what they've been hinting at up to this point. How does all this matter to consumers? Well, mortgage rates are still high, so we talk about housing, we talk about new home starts, we talk about new construction starts, and housing is a very big component of our economy. If consumers are wanting to buy a home and what's holding them up is the price of borrowing that money, the lower interest rates go, the lower mortgage prices go, the more inclined people might be to buy houses or to buy other stuff, to borrow money just in general, and that's going to continue to fuel this economy.
And mortgage rates went up above 7% on average this week for the first time since May. Is there a good explanation for why mortgage rates are going up when the Fed has been actually cutting the shorter-term interest rates?
Well, a lot of it has to do with inventory and demand, and the fact that the Fed said that they're going to pause. There's no hint in the short term that rates are really going to budge. I mean, Joel, when I bought my first house, I got a rate at like 8.5%. I was thrilled it was single digits. To me, a 7% mortgage on a 30-year fix looks, average, below average. But I think we've been spoiled as consumers for the last 15 years because rates were so low for so long artificially. Personally, I think that the Fed keeping rates a little bit higher for a little bit longer isn't necessarily a bad thing, only because it can help to reset that psychological floor that a lot of consumers have with rates being where they were for so long.
And Joel, I think it's important also for people to realize that, the Federal Reserve only controls the overnight rate, right? And that's very much at the short end of the curve. So not necessarily having an immediate impact on longer term rates. And I think what we've seen in this particular instance recently is that the 10-year has actually gone up a little bit, did at the end of last year, even after the Fed was cutting rates. And sometimes people think that that's not congruent and almost contradictory, but it really depends on why the Fed's cutting or not cutting. And in this particular near-term environment, there's probably more optimism for economic growth and things going maybe a little too high. And that's why I think you're seeing that disconnect between recent rate cuts and the longer-term rates going higher.
Yeah, Dave, for those paying attention to the yield curve over the last couple of years, we've seen now a yield curve that's becoming more normal. Because that 10-year ticked up and you've got the Fed pushing short-term rates down, the yield curve has started to normalize. We want rates to be paying less for the shorter amount of term that you're borrowing money. You should expect to pay a higher rate for the longer amount of money that you're for the longer term that you're borrowing for, and that just signals that the economy is healthy. 3 years ago, we had a yield curve that was inverted because the expectation of the economy was one of slowing down, and nobody wanted to commit their dollars to anything longer than a few months or a few quarters. So the 10-year ticking up, the Fed pushing rates down in the short term, does signal to us as investors that this economy is getting healthier.
Is there a unified question, a common question that you're getting from investors as to the bond side of their portfolios and what all this means to them and how you're setting up their expectations?
Yes, Joel, bonds obviously been a pretty common topic here over the last few years. And I think a lot of our investors and a lot of clients are suffering a little bit from recency bias and are afraid of bonds. 2022 was one of the worst years on record for the U.S. bond market. And I think that stung some people. I think it shook their confidence in the bond market. But I think patience is really the key here. With rates being elevated now, especially in that intermediate bond space and the 10-year trading somewhere in between 4 and 5%, I think that the future of the bond market would show or would lead us to believe that we're back more to more reasonable historic bond returns, not the artificially low rates that we experienced for the last 10, 15 years where the bond market really was substandard in their returns.
So those bonds are actually doing more work for investors.
Yeah, I think that, we always used to refer or always do refer to your yield as being kind of the cushion and shock absorber to protect you on price swings. That cushion was eliminated for many years. I mean, when yields went down to 1% and 2%, you felt every little bit of any price swing in the bond market. Now, if your yields are at 4 to 5%, now you got a little bit of room on there to protect you from volatility on the bond side. So I think they're returning more to their former self, I'll say.
Well, and for those consumers that are complaining about how expensive it is to borrow money to buy houses or to borrow money to buy cars, those same consumers are thrilled to see their banks paying them 4.5% on CDs again. So it does cut both ways, and I think that the silver lining to rates being where they are is for investors that have cash in the bank or investors that have some emergency funds that they just want to tuck away into some kind of fixed income component, they're getting paid for that fixed income.
Great. Thanks, Steve. Max, as you promoted yourself at the beginning of the show, we wanted to take a moment here and have some reflections on Bob Uecker. The state, the nation has lost a great voice, as you referred to him, Mr. Baseball. Now, you happen to have gone to the same high school as Bob Uecker?
I went to the same high school as Bob Uecker.
You worked in the same, you also were in the radio, Milwaukee radio market?
I worked on an FM station, and in the same building was an AM station. I worked at WLPX, and WISN was the big news station, and they got the Brewer broadcast for 2 years. They somehow stole it from WTMJ, and so they had it for 2 years. And Uecker would come into the building, not frequently, but he would stop in and do some promotion on the radio. Well, he would have to walk by the FM studio to get to the AM studio, and as he walked by, we would grab him and pull him into the FM studio, and we would gag around and laugh and have fun until the station manager got upset with us, and Uecker said, "I'll talk to whoever I please to talk to." So Uecker's my guy.
So the station manager was upset. Why?
I think they paid a lot of money for the Brewer broadcasts, and they didn't want to dilute it. So Uecker would come and sit in with us, and we would have a good time. And at one point, after gagging around for 3 or 4 visits, he gets up to leave, and he points at me and says, "I will see you later." And I took it to mean that I'm going places with Bob.
Oh, okay. It wasn't a threat. It was a, hey, you're coming with me, kid.
That's what I thought. I was only half right.
Well, because of course, so that was he was in Mr. Belvedere.
Yeah.
He was in Major League. All 3 of those versions of that movie. Yeah. He was. This amazed me that he was 100 times a guest on the Tonight Show with Johnny Carson.
I think it's 140.
140. Oh my gosh. Wow.
Yeah.
But he's, somebody told me yesterday that they thought he was the most beloved Wisconsin resident ever. And I took pause and I thought about it, and I can't dispute that. I'm having a hard time thinking of anybody in baseball or beyond who had the clout.
I was pleasantly surprised by all the national network coverage that Bob got. It just spoke to how beloved he was, how valuable he was, and how people revered him. And he was doing play-by-play at the age of 90, and people are still quoting him.
And still on top of his game. Yeah.
If you got time, I got one more for you.
Sure. Yeah.
Okay. We had a promotion, and we gave away these little bitty catcher's mitts. Uh-huh. They fit on a keychain. And Bob Uecker was a catcher, of course. Right. So we were giving away to anybody that cared to stop by the station and pick them up. And so I put one on my index finger out in the lobby because I'm hanging out there. And Uecker and the station manager are walking through the lobby, and I get down in the catcher stance, and I start doing the catcher chatter. "Hey, batter, come on, pitch it in. Come on, batter, you can't hit the stuff, And Uecker looks at me, and he looks at the station manager, then he points at me and says, "Fire that SOB." Yeah, Uecker was fun. He'll be missed.
Yes, he will. Thanks for sharing that. And again, our best wishes to his family and all the fans out there. And just as a programming note, wanted to remind everyone that Landis and Company offices and the stock market itself are closed on Monday, January 20th, to honor Dr. Martin Luther King Day. Thanks for listening, and we'll talk to you again soon.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.